Physical climate risk is repricing corporate assets in 2026. Physical climate risk is repricing assets faster than corporate financial models account for. The financial assumption built into most corporate asset valuations is that climate impacts are a future problem priced into long-term projections. That assumption is wrong in a growing number of markets, and the repricing is happening now. Corporate financial models have generally treated physical climate risk as a long-horizon variable, something to include in scenario analysis, disclose in risk factors, and address in capital plans that extend beyond the current planning cycle. That framing is being overtaken by events in markets where flooding frequency, extreme heat days, and multi-year drought conditions are already affecting insurance access, facility operating costs, and property values in ways that show up in this year's financial statements, not the next decade's. For C-suite and finance leaders, the gap between how physical climate risk is modeled and how it is actually arriving represents a material blind spot in capital allocation and asset valuation. How insurance markets are signaling physical climate risk before financial models do. The property insurance market is the fastest moving leading indicator of physical climate risk repricing because insurers price and withdraw from markets on annual renewal cycles rather than multi-year planning horizons. What is happening in those markets should be informing corporate financial planning more directly than it currently does. In 2023 and 2024, multiple major insurers withdrew from or severely restricted coverage in California, Florida, and parts of the Gulf Coast, citing wildfire, flood, and hurricane exposure. State Farm and Allstate both stopped writing new homeowners policies in California in 2023. In commercial real estate and industrial markets, the dynamic is less visible but structurally similar. Insurers are raising premiums, reducing coverage limits, and in some cases declining to renew policies for facilities in high-risk zones, regardless of the facility's own loss history. The First Street Foundation's 2024 Property Risk Report found that 39 million U.S. properties face material flood risk that is not reflected in current FEMA flood zone designations. For corporate facilities in those zones, the insurance gap is becoming a carrying cost issue that affects both the operating economics of those assets and their fair market value if they were to be sold or refinanced. Where stranded asset risk is emerging in corporate portfolios. A stranded asset in the physical climate risk context is a facility or piece of infrastructure whose expected useful life and financial return are impaired by climate conditions before those conditions were priced into the original investment thesis. The concept is familiar from the energy transition discussion around fossil fuel assets, but it applies equally to facilities exposed to chronic heat, flood, or drought stress. Swiss Re Institute's 2025 Sigma report on natural catastrophes estimated that uninsured losses from natural disasters reached $187 billion globally in 2024, with the protection gap, the difference between economic losses and insured losses, widening year over year. For corporate asset managers, the protection gap represents the portion of climate-related loss that flows directly to the balance sheet rather than to an insurer. In the U.S. industrial sector, facilities in floodplain-adjacent locations in the Midwest and Southeast are facing a combination of rising flood frequency, increasing insurance costs, and in some cases, loss of insurability for specific perils. A facility that cannot obtain flood insurance cannot be used as collateral for conventional financing at standard terms. That is an asset impairment, and it is showing up in lender due diligence before it shows up in corporate disclosures. Why corporate financial models are lagging the physical risk signal. Most corporate financial models use historical loss data, insurance renewal costs, and discounted cash flow assumptions that were calibrated in a climate environment that no longer reflects current or near-term conditions. Physical climate risk models have improved significantly, but the uptake of forward-looking climate risk data in routine capital allocation decisions has been slow. The MSCI Institute's 2025 Corporate Resilience Survey reveals that while 94% of companies conduct site-specific physical risk assessments, 68% focus on short-term horizons, 2 to 5 years, rather than long-term capital planning. Furthermore, over 80% of companies reported direct impacts from extreme weather in the last 5 years. The majority were relying on historical insurance loss data or generalized scenario analysis that doesn't resolve to the facility level. That gap is significant because physical climate risk is intensely geographic. Two facilities in the same industry can have fundamentally different risk profiles depending on their specific location within a watershed, coastal zone, or heat island. What C-suite and finance leaders need to do before the next capital cycle, the practical steps are within reach of any organization with a defined asset portfolio. Facility-level physical risk screening against current climate projections, not historical FEMA or insurance data, is the starting point. Organizations should know which of their facilities sit in zones where chronic heat, flood frequency, or water stress conditions are projected to materially worsen within a 10-year horizon, because 10 years is inside the depreciation and financing horizon of most capital investments being made today. For finance teams, the question that needs to be in the capital allocation process is direct. Does this investment assume operating conditions that climate projections suggest will not exist for the full useful life of the asset? If the answer is uncertain, the investment case needs a climate stress test before approval, not after the asset is on the books. You've been listening to Sustainability Soundbites by Environment and Energy Leader. For partnership opportunities, please reach out to our team.